Hello everyone, happy Wednesday. I hope you're all well. Thank you for joining. We're back with our regular slot now, hashtag Askrobco, back at Wednesday, every Wednesday, 1 p.m. So sorry for the disruption over the last week. I've been traveling, going to banks all over the world, going to different offices. So many apologies for that, but we are back on the Wednesday slot, so put it in your diaries every Wednesday at 1 p.m, same time, same place. James is with us today. Dan is in the background today as well, producing the show.
Hello.
So great to have you both with us. We've got some great topics today, and we are focusing on sales data, market uncertainty, and what's been happening with stamp duty, etc. And the big news of the week, and everyone listening, especially all of you in credit and risk and sanction and reporting for valuations, the big news of the week is that the market uncertainty clause from the MRICS has been lifted for C3 single dwellings and for HMO investment valuations. This is really important for those of you at the banks that are receiving valuation reports for single dwellings and HMOs. The market uncertainty clause has been lifted. What does that mean for you? Whoever in your bank or operation is reviewing those reports now needs, if they see the clauses in the report, it shouldn't be there, or if there's justification for it to be in the report, you need to challenge the valuer and say, why is it in the report? And they will say, there are no comparable evidence post lockdown COVID for us to rely upon, or the property is so unique in its character and its nature, or there's no new evidence, whatever the reason, that's why we're putting the uncertainty in. If they don't have a justification now to have that uncertainty, so another example, for those of you that are doing valuations in Leicester and they're still in lockdown, the uncertainty clause can remain because there's a spike there and things aren't moving forward. So it's really important. Any questions you've got relating to this, you know how it works. You've got your chat question column on the right hand side. You ask the question, fill in the box, and we will answer whatever your question is. Relating to market uncertainty, if you've got a special question around it, put it in the box now and we're going to answer it. So let's just go through that one more time, and then James can give us his view and explanation. Single dwelling, C3, market uncertainty clause is out unless there's special justification for it to remain. All the reports you're receiving now for your risk, credit, sanction, new deals, you need someone reviewing those reports to see if the clause is there. And if it's there, why? Ask for justification. If there's no justification, ask for the report to be redone with the market uncertainty clause being removed. Why? Because further down the line, if you have a valuation and you want to challenge it, or you think the work hasn't been done correctly, if the clause is in there, there's less reliability on the report because of the clause, and that's the whole point of having it. And so to protect you, risk, credit, sanction, any of those on this call now, you've got to be on top of this now, because you don't want a crossover of reporting that's relying on an uncertainty clause when the clause shouldn't be there. If we go back 4, 6, 8 weeks, all of you were asking me the question, how long will the clause be there? How long will the clause be there? How long will the clause be there? I said to you that post lockdown, so post us being able to go out and do our work full on like we are now, we need to wait for sufficient volume of sales to go through. The MRICS and the banks involved have decided that now is the moment, thus the switch is happening. I always said it could be 4, 6, 8 weeks. We're now 3rd week in July, and more or less, it's six weeks, 7 weeks, more or less exactly what I would have said. So please be aware of that. Any questions you've got relating to that, please ask it now, because this is really important from credit risk, sanction, liability, insurance. It's a really important point. Lee, before we go to James, Lee's just asked a question. Thanks for joining, Lynn. What is the specific date the uncertain clause does not apply from, please? So this specific date from the RICS is Friday, the 17th of July. I will come back to you on that one, Lee, just to 100% clarify. But we got given the update late on Friday, to which Monday, Tuesday, Wednesday of this week, we've been changing the way that we operate. Just make sure that all the valuations that you're receiving this week that have the clause in the specific areas I've said, because if you're doing commercial and it's not the HMO product, then there's complete reason to have the uncertainty clause. So you've got to understand that it's single dwelling, C3 use, HMO. I've been telling you for the last few weeks, HMO is a product that's doing really well at the moment. Investors like that market. We're seeing lots of transactions. That's the reason why the uncertainty clause has been dropped. Values at the moment are stacking up, and there's a lot of demand for HMOs. So it's obvious. I said to you in the last few weeks, where are we seeing strength in the market immediately? I would have said residential and HMO. No coincidence, RICS had dropped the uncertainty clause. James, what do you got for me on that one?
Yeah, so at the end of last week, it's a very positive move from the RICS to drop the material uncertainty clause, and I think it goes further into the market than that. It's good news for market sentiment, bringing some more positivity. So from, as you said, end of last week, we're going to see valuation reports being issued without that. So gives the lenders more comfort and more comfort in the market. But I mean, the lockdown saw a bit of a pause on the property market, with that period from the end of March seeing a trickle feed of largely off-market transactions going through over the course of that time, probably up until the end of June, start of June, before the market reopened, which the starting position seems to have been sort of broadly resuming from where it was, with some markets being slightly more affected than others, but those statistics are yet to be sort of come out from the data we're seeing, but sort of in the region of sort of 5% or so, sort of the more worse affected areas. One thing I think is going to be very interesting to see in the sort of short to medium term now is, and especially when the sort of furlough schemes end, is how the unemployment, the sort of any possible rises in unemployment have an impact on the market, and how sort of lenders treat those individuals that have been on furlough for some period, and what their sort of criteria is there.
Yeah, I mean, definitely, I definitely agree with your point about sentiment. For the banking people on this call, you know, I was part of your stakeholder calls where they were very uncomfortable with the uncertainty clause, and this is something really positive now. And I know 50% of you on the calls are coming from the risk, credit, sanction side. This is really positive to relate back to your stakeholders. It means that you can move on with your lending and your business with the certainty and the sentiment that you had pre-lockdown. And this week is the first week where you've got that in place. So individually, I'm going to send the RICS update to all of you and your colleagues anyway, but please share with your stakeholders, because it's a really positive move and we've been waiting for this. Please keep sending your questions through. The ones that you've sent through so far, we've answered the questions on. I'm going to go to the latest sales data and figures. I know that's a part of the show that a lot of you love. Handout number 5, that's 17-week post-lockdown. So if you open up handout number 5 on the right-hand side, I know sometimes some of you on audio don't get to open it, but the ones on your computers can. And we're going to go through those numbers. Anyone that needs those figures outside of this call, happy to email them for you. We use internal MJ Group information along with Lonres data. And just so that you're aware, next week we've got a special show partnered by Lonres. It's going to be a 1 hour prime, super prime, London Resi special on data and intel with our partners Lonres and MJ Group. Very, very special occasion. We're literally going to have hundreds of people on that call, and probably every major bank in the prime, super prime, London and surrounding areas space. We've got the head of research for Lonres joining that. And I think when you've got market leader, MJ Group, and data leader in terms of transactions, Lonres, you bring us together. I think we're going to have a really great show. So I strongly recommend you tell your colleagues and bring them onto that, because it's going to be a very special edition. That's going to be next week, 1 p.m, partnered with Lonres and MJ Group. You'll get the promotion material for that. Okay, so let's have a look at the sales details this week. Last week, for those of you that weren't with us, which was week 27, we had 753 new instructions that came onto the market. To put some context behind that number, that was the highest weekly figure of new instructions that we've seen in the way that we manage our data and intelligence in the areas that we work in for over 4 years since the Brexit referendum. So we're talking about once in a half a decade week of instructions, not seen before. That is pretty huge on the back of stamp duty and on the back of the momentum that we're seeing in the market post-lockdown. Those numbers are crazy. And not only that, it wasn't a one-off, because this week we're at 646, which is the third highest week of the year in terms of volume of properties coming onto the market. And remember, coming into January and February, the market was buoyant. We had a tremendously strong start to the year. How is that moving on to sales details and to properties going under offer? Again, very strong. We're at 365 for the numbers under offer. Again, third or fourth highest under offer week of the year. And then the sales figures are at 121, a bit too less than last week, 123. To put into context, we're still below the volume going through from January and February. But think about pipeline of sales. I said this last week. It takes on average 6 to 8 weeks for sales to go through from coming onto the market to under offer to exchange and completion. That means when we hit September of this year, 6 weeks, 5 weeks from now, I estimate that the volumes of sales completing is going to be at a high level, and we're going to see some really good numbers. That's just how long it takes the pipeline to go through. And when you see the numbers that we're looking at, it's very, very positive. And I see now that that's going to continue for the next few months for sure. The numbers and the indication we're being given, the agents we're speaking to, the conveyances we're working with are telling us they have volume of properties, under offers, deals going through, very positive signs at the moment. Any questions relating to the data, the intel, please get them through to us now. Let us answer the questions, because this is really important from the positivity and the demand side that we're seeing with supply coming on stream, because you need buyers, but you need properties for them to buy. We're seeing a good equilibrium here. With the good equilibrium coming through, that creates momentum, and the momentum is creating positivity, and that's playing out in the volume of valuation work we're seeing and the positive sales figures we've got coming through. James, what do you got from us for us in this space?
So in terms of the sector, and the supply of housing, which we mentioned, I just wanted to touch on something that's been in the press. I think it was released today, actually, that NatWest has pledged 3 billion in funding, in new funding, sorry, to release by the end of 2022 for the RP and HA sectors, which is registered provider and housing association sectors, which I understand is to support the development of 20,000 new homes, something of which in the last 6 months we've seen a pause, really, of sort of pipeline of development. We've had sort of construction workers only just starting to get back onto the sites, and just sort of list a few sort of leading names in that sort of RP, HA sector. So you can sort of largely operating across London, but you've got L&Q, A2 Dominion, Catalyst, Curo, the Guinness Partnership, One Housing, Peabody, and we just wanted to sort of raise the awareness, maybe have a discussion about how the supply of that housing could actually support the rest of the sector in terms of the sort of private sector, as well as supplying shared ownership, social housing across London.
Yeah, I mean, listen, understanding where the money is going, where the interest is, what the trends are, what specialist areas we're seeing along the trends that you've just mentioned, James, is part of our job, part of this platform of the information we want to be feeding you. And obviously, when you're working in specialist areas, whether it's student accommodation or build to rent, and you're a specialist lender with a specialist product with specialist pricing in those areas, if you need us to go into more detail or want to spend more time on them, then please do. Historically, I've been telling you over the last few weeks, high street supermarkets, hypermarkets, stroke the larger retail space in terms of logistics and distribution is performing extremely well. The HMO market is performing extremely well. Residential dwellings are performing extremely well. So from your risk appetite and your lending appetite, understand that's the strength. High street retail is challenging. The office market is challenging. You've got to understand your exposure and your risks and your product and your pricing, and have that as a relative relationship in terms of what the demand and what the supply is and what the market is looking for. We are on the ground, as a business. When we see something happening on the ground, we're first to market because we're seeing the live drivers and the data and the intel, and what James and I are sharing with you is not hypothetical scenarios or what the press are saying or what might be happening. It's real. Why? Because we're a live barometer of activity. If we're busy in HMOs and residential property in surrounding areas of London or prime properties in London, that's because the market's performing. If we're not doing any HMOs or investment product in that area, or nothing's happening in prime or core London or surrounding areas, that means the market's not moving. That's the beauty of what we're sharing with you and the relationship we have with sales, lenders, credit, sanction, risk, data intel. It's because we're live on the ground and we get a volume of business that we're then able to share with you that information. What other questions you got, James? Please keep sending your last few questions. We've only got a few more minutes.
Yeah, I just wanted to add to that. The construction sector is such a large proportion of the country's GDP that I think, again, it adds a positive sentiment to the property market as a whole. And just the multiplier impact of that construction sector, whether it be in the social housing side, shared ownership, or the private sector, I still think the multiplier effect on that in the market is one which is very positive. Another sector which I just wanted to touch upon was the retirement home sector, as the sort of market leaders in this, McCarthy and Stone. Going back to 2015, they did their IPO, valuing themselves at almost £1 billion. They've recently slowed in terms of their performance, having some pre-tax losses of around 90 million, which they've announced the past week. And this is largely cited due to project interruptions and slowing due to COVID, pausing a lot of their development pipeline. However, with an aging population in the UK, something which is becoming more aging, is this market going to remain robust, do we think, in the coming years, or is there going to be any changes to that?
I mean, listen, the care home market with an aging population has been where a lot of money has gone in investment, construction, new build, funds, pensions, have put a lot of money into those areas. And even if the dynamics change in terms of requirements and needs from individuals within that space, without question, at a UK level, but even at pan-European level, the demographic play is definitely for an aging population that's going to grow stronger and stronger and stronger. So I definitely am seeing the trends of acquisition and market movement being strong and secure in that space, even if the requirement at ground level of what is being provided in that space might change because of what we've seen with COVID and the new requirements and possibly new legislation that will be brought in. So I do think it's a really, really interesting space moving forward, but a space that will stay strong because demographics are strong in that area. Next question, James, what you got?
Well, moving on from the retirement sector, it was those build-to-rent sectors, and if we sort of viewed those as being possibly something which could sort of continue to thrive in the coming years, whether sort of social migration might have any impact there, people wanting sort of greater flexibility in their living situation, those sort of more short-term options of build-to-rent, giving people high-quality accommodation, but whilst also giving them flexibility.
Yeah, so listen, everyone on the call knows I've been a big pusher of build to rent as a market, and I see it as something that's growing massively, investor, institution, funds, etc. The locations of that product is going to become quite important now. Is it commuter location, central city location? You know, there could be a slight change logistically in performance of that product, but from an institutional perspective, it's loved and wanted and will grow and grow. But the dynamics might change slightly, and we won't know those dynamics for maybe another 6, even 12, even 24 months, because we need to know whether there's going to be a new state of play here. Is there going to be a shift in rental demand of where people want to be living, and will pricing be affected by that? At the moment, we're actually now seeing rental pricing and demand shorten and come in, and that's quite interesting because initially there was pent-up demand for rental accommodation, and it was really strong the second that people were able to start seeing properties again. Now the data that's coming through is actually pricing has fallen slightly in certain areas and demand has fallen slightly, and we're going to have to watch that space, and it's quite important, especially for the buy-to-lets product that a lot of you are doing. If rental pricing is coming in slightly or demand is shortening, that could be void periods extending, and it could also mean that the requirement for mortgage lending in terms of LTVs and payments might be reduced slightly. So I think we really need to watch that space. Last question of the day, James, what have we got? What's the last question?
Well, I was just going to recap upon the material uncertainty clause being lifted by the RICS. Again, just for anyone joining late, it includes the material uncertainty clause being lifted for residential C3 dwelling houses and also HMOs up to 6 people. So really those HMOs which are sort of mainstream in terms of what they are, but excluding those more specialist HMOs, which might be more than six rooms, 6 bedrooms, falling into the C4 category, whether it be those blocks of sort of studio apartments, being non-self-contained, being below 30 square meters. That's the update from the RICS, but surveyors will still have the opportunity, the option to apply the material uncertainty clause if they have certain concerns about the asset. Is it heavily adapted? Is it very specialist? Is there a niche market? Is it readily saleable to investors, investor-led demand?
What I love, and the closing point for today, what I love about the uncertainty clause and the changes we've seen over the last 4 or 5 weeks, and I'm going to share it with you. It'll probably be on next week's handout, or I'll put it in the emails. Just think, it started with supermarkets and government stock and logistics and distribution as the strongest performing areas through COVID-19 and lockdown. So you couldn't use the market uncertainty clause in those areas unless it was specifically required. Now we're moving on to HMOs, like James has mentioned, and single dwellings. What does that tell us? We know the performing markets in the UK at the moment, which is why the RICS are dropping the clause. So anyone that's lending in those areas should be given a degree of comfort to know that that's where the demand is, and they're the areas that are performing. The ones that aren't performing, leisure, shopping centres, retail, office space, they're in challenging markets. So understand what's performing, which is what we're telling you, which is where the RICS are changing their viewpoint on market uncertainty, and understand what's not performing, and work your books and your risk policy and your lending in accordance to that. And we'll keep updating you every week when we see the changes. All right, brilliant questions today. Very positive news from sales, from RICS market uncertainty. Next week is going to be a huge special show. I really strongly recommend that you bring your colleagues in, because we're partnering with Lunres, head of research. It's going to be a really good one. I really expect loads and loads of great questions. We're going to probably make it, I think, 45 minutes, maybe even an hour. There will be hundreds of people on that call. So make sure you come back next week. Special hashtag Askrobco, MJ Group partnering with Lunres, head of research. See you there at 1 o'clock, same time, same place. Thank you for all of your support. Thank you for your questions. Have a great week. Stay positive and see you next week. Thanks, James.
Thanks for your time, everyone.